Hello and welcome to Unit 10 of Governmental Financial Analysis, Other Analytical Issues. And I generally refer to this lecture as the All Other lecture. We're going to address a wide-ranging variety of other topics that could be relevant to the analysis of financial health of a government. Certainly not all of the other issues, but other things that are specifically fed by accounting and financial reporting, and then to talk about some more qualitative issues that are equally relevant as the quantitative issues that we focused on almost exclusively up to this point. As you know, the financial reporting entity is essentially defining the boundaries of the government, what constitutes the government. And it includes not just the primary government, but also legally separate entities referred to as component units. So it's important, when you're looking at the financial health of the government, obviously, to understand the financial relationships it has with other entities, both governmental and non-governmental. So you want to look at those component units of the government and understand what its financial relationship is. There almost always has to be a financial benefit or burden relationship between the government and this legally separate entity in order for it to be considered a component unit. And therefore, you want to look at the nature of that relationship. Is this other entity going to provide financial benefit to the government, or is it going to prove to be a burden and a drain on the government's resources? You also want to look at other types of financial relationships with other entities apart from component units, including joint ventures, when the government goes into business with so to speak, with other governmental entities and even non-governmental entities to provide a service. For instance, a city and a county might, partner to operate a public zoo. Jointly governed organizations, you're living in an area, many of you who are, from the Northeast, where Rutgers is, where you have probably the prime example of that, the Port Authority of New York and New Jersey, which is a jointly governed organization of both New York City, in New York State, and New Jersey, and then related organizations that are government separate entities that the government has a relationship with, and where there may be some financial interaction. And basically, in the case of all of these joint ventures, jointly governed organizations, related organizations, and component units, your analysis basically comes down to the same thing. Will they provide a financial benefit to the government, or is there a financial burden? And what is the magnitude of it, and what kind of impact is it going to have on the financial health of the government? One transaction we haven't talked about up to this point, maybe we've alluded to it a little bit, are service concession arrangements, or SCAs. Service concession arrangements are essentially very long-term leases that a government will sign with usually with a company, but in some cases, and increasingly more so, with other governmental entities, to have that other entity, which is referred to in the standards Statement 60 as the operator. The operator will assume the rights and responsibilities for operating a major capital asset, such as a toll bridge or a toll road. Those are the most common examples. It's something where the operator can generate revenue, and their goal here is to make money, obviously. And typically the way these are structured is the operator pays the government a large upfront cash payment. These have become somewhat more common, over the past decade or so. Some have worked well, some have been total flops, governments are looking for new and creative ways to raise money, to reduce their operating costs, and to build needed infrastructure assets. And SCAs are one of the ways that they've been pursuing that. Um, Very briefly, the accounting standards require that that upfront payment be reported as a deferred inflow, so you may very well see that among the deferred inflows in the financial statements. And then the government will recognize that deferred inflow rationally and systematically over the term of the SCA as revenue. So then it allows to report it as revenue up front. So it's giving them budgetary help because they've got this large amount of cash to use now, and they probably spend it all almost immediately. There are examples where governments have been a little smarter and taken at least some of that upfront payment and put it aside for other capital investments or other purposes, or emergency funds and things like that. But a lot of governments have pretty much spent the money immediately. But you don't want them reporting that as revenue right away. It is revenue over the course of the agreement. A lot of SCAs involve the government promising to do certain things for the company. For instance, they may promise to provide certain ancillary services like safety, public safety, policing, and things like that. So, to the extent they have made any promises of this sort in the agreement, the government has to recognize a liability that represents the cost of those services. And then the disclosures related to SCAs involve describing the nature of the arrangement, information about the assets, liabilities, and deferred inflows related to the arrangement, presuming that they may not be individually identifiable in the financial statements. They're aggregated with other assets, liabilities, and deferred inflows. Any rights granted or retained as a part of the transaction, and then whatever guarantees or commitments the government has made to the operator as a part of the arrangement. We certainly spent an entire unit looking at long-term debt. Short-term debt, is obviously a common transaction for governments as well, primarily for the purpose of managing cash flows. Because as you know, a lot of spending, particularly operating spending, takes place, fairly steadily throughout the year. There are, payrolls, every 2 weeks or however frequently, and they tend to be more or less the same or very close to the same amount. Utilities are due once a month, rent is due once a month, and so on. However, revenue tends to be a lot lumpier and a lot more, episodic rather than periodic. For instance, property taxes will come in either at one point during the year or at one or more times during the year, rather than getting a steady amount every month. Income taxes obviously, tend to be coming in on a quarterly basis, and then in a large amount, on filing dates. And plus, there is withholding tax that does come in on a regular routine basis. A lot of intergovernmental aid from state or federal governments may come in later in the year. But the point here is that the government may need to borrow in the short term in order to make sure it has enough cash to pay its bills until the revenue comes in. And so these are probably the four most common type of cash flow management short-term debt instruments: RANs, which are repaid with general revenues; tax anticipation notes, which are repaid with taxes; tax and revenue anticipation notes, TRANs, so that's a combination of tax and general revenues that are being used to repay, or could be operating revenues as well. And then BANs are issued in the short run until the transaction for issuing longer-term debt in the form of bonds comes through, and then the short-term notes are repaid with a portion of the proceeds from the bond issuance. Things you want to know about short-term debt is why did the government borrow? You want to make sure that that the rationale for doing it is just normal operating procedure and not an emergency. You want to know how much the government borrowed and whether that amount is changing over time. One would expect that if a government is borrowing as a normal course of operations to manage cash flows, that because the size of its budget is growing over time, that the amount that it would borrow short term would grow over time just to keep pace. So you want to, I think, look at the size of the short term borrowing compared with the size of spending overall, and see if it's growing. The amount borrowed is growing faster than the amount of spending, which may suggest that they're growing increasingly dependent upon short-term borrowing, and that could be a signal of financial difficulty. You also want to make sure, is it fully repaying its short-term debt? In a lot of places, New York State, for example, if a government borrows short-term, it's required to fully repay it before the end of the year. It's not allowed to carry short-term debt from one fiscal year to the next, and that's a direct result of the New York City fiscal crisis in 1975, where they were borrowing short-term and in increasing amounts and essentially rolling over a large and growing operating deficit from year to year. That law is meant to prevent governments from doing that. If you look at the bottom of this slide, you can see what a typical short-term debt disclosure looks like, and it has a structure that is similar to what you've seen for capital assets and for long-term liabilities, where it's showing you how the amounts have changed during the course of the year that is being presented in the financial statement. So you see the beginning balance, how much was issued during the year, how much was repaid, and the ending balance, if any. And certainly if you were looking at this for a government in New York State, where they're not allowed to carry over short-term debt, you would expect the beginning and ending balances to be zero. But in some places it may not be. And so you want to track that and see, is the amount that they have outstanding in short-term debt growing over time? That could be an indication of financial trouble as well. Termination benefits are transactions with employees that are intended to encourage them to retire or to otherwise leave the employment of the government. Governments that are in financial difficulties may enter into these transactions in order to trim the size of their payroll and not just to remove any employees, but those that have been around the longest and therefore are generally the ones that are paid the most because they've been there longer than anyone else. Typically, these involve, sometimes a cash inducement, but most of the time they have something to do with the post-employment benefits, the pensions and OPEB that the employees receive. So typically you might see something like, it'll say, we'll give you the full credit you normally would get if you retired at 65. We'll give it to you. You can be as young as 62 and still get the full package. You don't have to wait until 65 to get all of your benefits. And so a lot of people will analyze these transactions to see if they really are, in fact, saving any money for the government. And a lot of times they're not, at least not in the long run. A lot of governments will structure these so they get a big upfront savings because these people are no longer receiving salary. So there's if they can get a bunch of people to depart, these longer tenured, higher paid employees, the budgetary savings could be significant. But a lot of the times what they promise them in terms of additional post-employment benefits ends up being far more expensive in the long term than if they had just allowed the people to work until their normal retirement period. So whenever I see termination benefits, that immediately makes me concerned about about at least the short-term financial health of the government and what decisions it might be making that could adversely affect the longer-term financial health of the government. And so you will definitely see note disclosures that will give you a full explanation of the nature of those termination benefits. Another source of long-term liabilities for a lot of governments relate to municipal solid waste landfills. Um, there are both federal and state regulations regarding the closure of landfills and how they are cared for after they're closed that impose an obligation on governments that own landfills like this that is so significant that you know that those future outlays they're going to have to make to close that landfill when it's done, uh, being operated, and then to take care of it afterward to prevent pollution, are so certain that those are clearly liabilities right now. And so governments are required by GASB Statement 18 to figure out what that cost is going to be and to report it as a liability at its estimated total current cost. So that's a liability that you will often see among the long-term liabilities of the government, and one that you should be aware of and that you should keep track of over time, because you will see the extent to which those estimates change. And you would expect, since they're based upon what the current cost is, what it would cost to perform those closure and post-closure care activities right now, or as of the date of the financial statements, um, one would expect that just the normal increase in costs through inflation, would lead to increases in that liability and expenses over time. Uh, and so this is something that's worth tracking over time, just the way you would track other long-term liabilities like claims and judgments, compensated absences, and outstanding debt, bonds, leases, and so on. When you look at the note disclosures for the landfills, you will see a description of what they have to do in general in terms of closing the landfill and caring for it, um, how they estimated what the total current cost is, what the liability amount is if it's not evident from the financial statements, how much of the landfill is left, to be operated if it isn't in fact already closed, how many, as well as how many years are left to operate it. And if the government's required to assure that sufficient uh, funds are available to close and care for that landfill when it does in fact close down, they need to disclose some information about how they're meeting those financial assurance requirements. Here's a related topic, also related to pollution, called pollution remediations, or PROs. Um, we talked in a previous lecture briefly about non-exchange financial guarantees, which are a contingency, a contingent liability for the government that is providing the guarantee, and it's accounted for differently from the general accounting for contingent liabilities. And PROs is another example where of a contingent liability that is dealt with differently than the probable threshold for recognizing liabilities under FASB Statement 5, which was brought into the GASB literature in GASB Statement 62. Essentially, part of the notion here with these standards is that some of the liability related to a government having a legal obligation to remediate pollution, to clean it up, will be recognized on the face of the financial statements, even though it ultimately probably is not the right amount, not the amount that it ultimately the government ultimately is going to have to sacrifice. So you kind of know based upon the approach for measuring these PROs, which is different from the way other contingencies are measured, that it's not going to be there's a chance it will be the ultimate amount, but there's an equally or greater chance that the amount will be something different. But at least you're getting something on the books, and you're aware of this liability, and it could be greater or it could be smaller, but it's something that you ought to be tracking along with other long-term liabilities. The way that the standards require governments to account for pollution remediation obligations when they have them is they don't have to wait until they know the full extent of what they have to do. It's called a component approach in the standards. That as they know each of the components related to cleaning up pollution and can reasonably estimate the cost of dealing with them, they will do so, and they don't have to wait until they know what all of the components are going to be, and what each of those components will cost. The approach to doing this is to look at what the cost would be now in a way that's similar to landfills, but it's based upon something called the expected cash flow technique, where the government is going to look at what the possible scenarios would be, if there even are multiple scenarios, but they usually will be, and they're going to look at what the probability of those scenarios are and the probability of the amount of outlay that would be associated with them, and essentially construct a PRO liability that is a weighted average of those potential outcomes based upon their probabilities. The disclosures that go along with the pollution remediation obligation include a description of the source of the obligation. Why, what is it that makes the government responsible for cleaning up this this pollution, which generally is going to be some federal or state law or regulation. If the liability isn't apparent on the financial statements, the amount will be disclosed. The methods and assumptions the government uses to measure the liability, and the potential that estimate of the amount could change, what factors would affect that, and if the government is able to recover some of the cost of the pollution cleanup through insurance, for instance, or by making whoever was responsible for the creating the pollution pay for a portion of it, or they might be able to get some intergovernmental aid to pay for a portion of it. They should disclose an estimate of what they think they're likely to be able to recover. In some instances, because this is a component approach and they're only including the components where they can reasonably estimate the amounts, if there are other liabilities that they can't recognize yet because they can't reasonably estimate the amounts, then similar to what they have to do for contingencies, they will disclose the nature of the pollution remediation obligation, but they're not going to disclose an amount. And they're going to do this regardless of how likely that remediation obligation is, unlike the other contingency standards where they have to do this disclosure if it's reasonably possible that they might have to make a payment. When we were talking about financial position, we did talk, I think, at least briefly about rainy day funds. It used to be more common prior to GASB Statement 54 to see them on the face of the governmental fund's balance sheet, either sometimes in a separate fund or sometimes as a line in fund balance. But the fact of the matter is that most rainy day funds really are not legally limited in a way that constricts how the how those resources in the fund can be used. And so governments really shouldn't have been reporting them as separate funds. In most cases, they weren't special revenue funds, certainly, and that's the only option that could have been used because there's nothing special about the revenue in those. It's not limited or committed, uh, or restricted to being used for a specific purpose. And in general, they probably shouldn't have been reported as separate lines in fund balance because they back in the day when fund balance was reported as reserved and unreserved, there really wasn't any legal limitation on how those resources could be used in the vast majority of rainy day funds. So to show those resources as if there really is some legal limitation on how they can be used really misrepresents the nature of those resources. And in most cases, they really ought to be reported now under the Statement 54 as unassigned fund balance. However, the fact that a government, has a rainy day fund, that it's trying to set some money aside, even if all they have to do is declare that it's a rainy day in order to use the money, the fact that they are at least saving some money, putting it aside as a buffer against unforeseen emergencies, is a positive thing. Certainly it's better than not doing it. And so it clearly was important to users of financial statements when Gatsby was working on that, on those standards, to know that a rainy day fund exists. And so Statement 54 requires governments to disclose when they have a rainy day fund, how much is in the fund, and the circumstances under which money is added to the fund, and the conditions under which a government is able to remove those resources and use them. 54 also, however, made it possible for governments to report, a fund balance line, for a rainy day fund if the funds in that fund are actually restricted or committed. The standards said that if they are restricted or committed, and the circumstances under which the money in the fund can be used are infrequent and unusual, meaning it's not something that comes along on a routine basis. It really is an unforeseen emergency, and that it's the terms are specific enough to make that clear. Then an emergency or a rainy day, could be treated as a purpose, and therefore could qualify to be reported as restricted fund balance or committed fund balance. But you will see very, very, very few of those because, in fact, the way most of these rainy day funds work, there really isn't any, strict limitation on when those resources can be used. Requiring a majority of the legislature to vote to use the money is hardly a serious limitation. Sure, it's better than not having any requirement at all, but when a government's in a pinch budgetarily, and it's faced with choices like raising taxes or cutting services or using its rainy day fund, invariably they're going to use the rainy day fund because it's the easiest choice.